Previously, we have talked about some of the company profiles, such as its basic information like address, stock exchange, sector, industry, and its senior management. Next, let's talk about something that are very important to investors, especially for those investors who are conservative. They don't like too much fluctuations about stock price. They like to take dividends about the stocks. Let's look at the dividends of a stock. We are now in topic 5. In topic 5, we talk about another perspective of a company profile, stock dividends. So how to know the dividend history of a stock? Well, in security market, some of the stock, they never send dividend, while some other stocks, they almost send dividend every year. Some company even send stock dividends many times a year. I believe the company, the stock who have dividends are usually welcome. The more dividends they have, the more welcome, the more popular their stock in market is. Let's look at multi first. The dividend and stock split of multi. This is the most famous multi. Its official price is one bottle, 1,250 kwai. However, usually in market, it's usually more than 2,000 kwai. Well, this one is pretty cheap. It's a couple hundreds, right? So, next one, you know, this is real multi, and the logo is here. And the logo literally means fly into the sky. Fly into the sky. This is the famous brand. Now let's look at multi's stock dividends. We have multi's stock price here, and our period is starting from 2011 to 2020. This is the dividend day. Of course, this is the weekday, and this is the dividend per share. Okay, it's RMB per share, right? Here, we do this case study at 2021, June 18th. The most recent dividend is 2020, June 24, per share, 17 RMB. And let's look at multi, 2011, 2012, 13, 14, 15, 16, 17, 18, 19. Every year they have dividends, and they have one time a year. Now you can see that part of the reasons why multi-stock price is high. Every year they have dividends, and their dividends is increasing. So this means multi-stock price is very attractive to investors. This is for multi. Now let's know something about dividends. In dividends, important is dividend dates. We usually have 4 types of dividend dates. First, we have dividend declaration date, and then we have record date, and we have EX dividend date, and then we have payment date. So which date is most important? Of course, this one is most important, and this one usually is the next day. Right? It's the next day, usually. So this one is pretty important. Usually, stock price will be down on this date. Why? Because this is the date. Before this date, a stock, they embed dividend, right? Stock, they embed or contains dividend. And after this day, the stock has no dividend. That's why its stock price usually will down. For a stock price will down, or for a uprising stock price, usually will stop uprising for a while, then uprising again. Usually these two situations. Now we can see the situation here. For example, 2020 June 24th. Let's check the stock price around here. Say, for example, we start from 2020 June 1st till end of July. Let's check multi. For example, we have multi price here, security price, multi date 2020, say for example, June 1st to 2020 July. Let's look at the stock price around this date, June 24th. See what will happen. Well, in this period, we can see that multi-stock price in general is in the upward trend. However, these are the period around EX dividend date, and the stock price stopped rising, become flat for a while, and after that, increase. So this one we call the dividend effect. The dividend effect. That means around dividend date, stock price will usually either goes down or stop rising. So you can find similar phenomenon in most of the dividend day around the stock. Now we learned the dividend effect, right? Okay, this is the case script for that. And we can have most recent situation about multi. So multi for most recent situations, just starting from until 2022. Now we find two more information about multi. First, let's look at this one. This is the previous one, right? And we have 2021 June 25th. It's a Friday. The multi has a stock dividend 19 RMB per share. For this year, 2022 June 30th is a Thursday, 21 RMB. So from this, what do we find? What do we find? We find that usually multi have one-time dividend a year, and usually it's around end of June or beginning of July. Or beginning of July, sometimes beginning of July. Right? And also we find that multi's stock dividend increasing. Increasing in terms of dollar amounts, increasing every year. While you are very difficult to find another company in mainland China security market like multi who have increasing dividend every year. No, you are very difficult to find the second one. That's why multi stock price is as high as something in the sky, right? Now we can also look at Apple. Let's try to find out why Apple's stock price is very attractive. Let's find Apple. For Apple, probably you can find something amazing as well. I hope this time this command can work. Yeah, it worked for Apple. Wow. What do we find? Let's look at this one. For last year, 2021. What do you find? Multi just issue one-time dividend every year. But what about Apple? Apple issued 4 times dividend every year. Every quarter, Apple it sends dividends to its investors. So what do you think about Apple stock price? Will be very popular in market, right? Many people want to buy Apple stock. Even Buffett also holds lots of Apple stock. And for this year, here, Apple already sent 2 times stock dividends. One in February the 4th, another in May the 6th. And next time, usually next month. So we can find out this early August. The third time, usually early August. Then we can have a summary on Apple stock price. First time, usually 4 times a year. Amazing, right? That means Apple has a lot of profits. First time, early February. Second time, early May. Third time, early August. Fifth time, early November, right? Wow, that's amazing. Simply amazing, right? Then we have comments for Apple's dividend. Next topic, we'll talk about stock splits. Stock splits. And the question here is how to know the stock split history. Still use multi as example because I like multi and I like multi-stock as well. Okay, so this is the multi-stock split. The most recent one is 2015, July 17th. It's a Friday as well. It's 1-to-1. That means if you have 1 share of multi-stock and after the stock split, you have 2 shares, right? You have 2 shares. And if the stock price is not changed too much, that means your market value of your multi-stock double, right? Double. This is pretty interesting. And then we can check the stock price around here. It's 2015, July 17th. Let's check the stock price changes around this date. Yeah. 2015, July the 1st, 2015. Probably we check it. Yes. July the 15th. Here we have. Yeah, this is the stock price. So we find an interesting trend that after stock split, stock price usually goes down. So roughly, how do we calculate the stock price after a stock split? Let me explain how to calculate theoretically. Okay. Here we have stock split. For example, right before the stock split, suppose its stock price is P0. And right after the stock split, let's suppose stock price is P1. And the stock split, suppose the ratio is 1 to N. 1 to N. That means if you have 1 shares before the stock split, and after that you will have 1 plus N shares, right? So roughly or theoretically, if we keep all the other conditions same, usually P1 equals to P0 divided by 1 plus N. So this is roughly theoretically, right? But for some of the very special stocks, it might be different. That means P1 usually is higher than this one. So we can say that this is expectations of P1. And the actual P1 sometimes is equal or higher than this one. This is the real situation in market. This is for multi. Okay, this is about the case script of multi. Then do we have any stock split for Apple? Let's try. I'm not sure about Apple. For example, we have Apple here. Probably have more about Apple. Let's see, for example. Oh, no, we are not looking for this one. We are looking for stock split information, right? Yeah. No, not this one. Not this one. Stock split for Apple. Here we also have a couple of stock splits for Apple. We can find out that the most recent one is 2020, August 31st. It's a Monday, 1 to 4. That means previously, if you have one Apple shares and after the stock split, now you have 4 shares. You have 4 shares. And let's look at the stock price changes around this date. 2020, August 31st. Let's check the stock price changes. It's around 2020, August the 1st, 2020, let's say September 30th. Now, let's look at the stock price changes around the date of stock split. Please remember this date. You will find something amazing. Okay, it's around here, right? You find a sharp down about Apple stock price, right? So before that, it is about 500 US dollars. After the 1 to 4 stock split, it drops to roughly here, right? This is 150. This is about 130. So you divide it by 4, it roughly equals to 125. This is roughly here. This is roughly here. So now we know a new effect. It's called stock split effect. Stock split effect. That means after a stock split, stock price will usually goes down sharply. Right? So this is very interesting. Suppose you know that for a stock, there will be a stock split, and you can do many things around here. Right? So this is where some smart investors earn money here. Yeah, we have Apple already. And some companies, they have amazing stock split. Let me show you one. For Amazon, there is an amazing stock split for Amazon recently. Let's check. Amazon. Now, what do you find? You find a stock price shut down here, right? So usually this means there will be a stock split. Will be a stock split. Now let's check its stock split. Stock split of Amazon. Let's check it. Amazon. Okay, we find that Amazon, there is a stock split here, 2022, June the 6th, Monday. It's 1 to 20. Wow, that is pretty amazing, right? Before the stock split, suppose you have 1 share of Amazon stock, and after that, you have 21 shares. You have 21 shares. Okay, that is amazing, right? Next, let's look at another topic. We look into a company. Now, our question is how to quickly and conveniently know something important about a company's situations, about its assets and liabilities. If you have learned the course called Principle of Accounting, I believe you will have some ideas about assets and liabilities. Probably something you still remember is the assets equals to liabilities plus owner's equity, right? So if you have learned a course called Principles of Accounting, in this part, we will talk 3 topics about assets and liabilities. First one, topic 7, we will talk about the assets quality of a company. And then we will talk about the short-term solvency of a company's liabilities. And then we will talk about shareholders' perspective about owner's equity. And these 3 parts are among the core parts of company fundamental analysis. Let me show you one by one. Topic 7, let's talk about assets quality. We know that every company, there are many assets. However, the assets owned by different companies, their quality are pretty different. Right? So how do we measure, how do we evaluate the different qualities of different companies? Of course, companies with better quality of assets, their stock price are usually better, right? So that's why we expect to know the quality of companies' assets. Our topic question here is how to analyze the quality of a company's assets. The quality of a company's assets. Of course, for quality of company's assets, we have many measurements, but which one is the most commonly used? This one. It's called ROA. ROA. We'll explain ROA in more details later, but I must tell you that the ROA is a measurement that are very commonly used in order to evaluate the quality of a company's assets. And here we have a couple of interesting companies. We have the e-commerce companies, both in China and US. So let me introduce one by one. Okay, Pinduoduo, we know that. Pinduoduo, right? And we know Jingdong. Here is Jingdong, US. We know Meili. Probably some of you may not know. Meili is a very famous, a booming e-commerce company in US, but targeting Latin America. Shop is Shopify. It creates the 3rd major business model in internet, in e-commerce. I don't think 3rd, maybe the 4th. Okay. The first model in e-commerce, it's business model like Amazon and Jingdong, right? First business model. The second business model is like eBay and Alibaba. And the 3rd business model like Groupon. And we have Meituan, right? And first, second, third, fourth business model is by Shopify. We call them independent merchant model. It's very different from the first three. Now we don't have e-commerce company in mainland China corresponding to this business model. Probably I believe someone is doing on this, but not famous for now. Now Shopify is getting very famous now, especially in US and European countries. And then we have Alibaba US, and we have Amazon. And VIP shop is called 唯品会. And we have eBay. In order to measure the quality of their assets, we use ROA. This is 2021, July the 1st. Okay, we'll explain ROA later. I must tell you, the bigger the ROA, the better the quality of a company's asset is. The bigger, the better. So which one is the biggest? In terms of quality of assets, we find eBay is the best one, followed by 唯品会. It's pretty amazing, right? And then followed by Amazon. And then Alibaba, Shopify, mainly Jingdong, and Pinduoduo. Wow, because Pinduoduo's net earnings is negative. For negative ROA, it is actually not comparative. So when we compare ROA, we usually ignore the negative one. Now let's look at what is called ROA. Let me explain what is called ROA. ROA refers to return on assets. This means for $1 assets, how many dollars of return could be generated? Here, return means net profits. So we can change the description in this way. For every $1 of assets, how many dollars of net profits could be generated? In this way, the higher the ROA and the better the quality of company's assets in terms of its capability to generate net profits. So ROA is calculated in this way. Net profits divided by assets, total assets. The higher, the better. Yeah. Okay, this is the case script for the topic case just now. First, let's define a variable. This kind of variable is called a list in Python. In the list, we have Amazon, we have eBay, Shopify, Meli, Alibaba, Jingdong, 唯品会, and Pinduoduo. Then we have a new Python command called compare snapshot. This command always compare the most recent information. It does not compare the history. This command is interested in only the most recent information. So compare snapshot. Okay, tickers here we will compare these companies. And the measurement here we will use is called ROA. Well, this is an option usually to adjust the horizontal axis. Whenever we see the horizontal axis look strange, we can use this option to adjust. Okay. Well, for example, we can do a quick exercise on that. Okay, let's look at this. Let's know the current information about this. Because the ROA situation changes every year. We expect to know the most recent one, right? Now, let's do it. Okay, we have all the information now. Now, let's look at the ROA information this time. We know that last year, Pinduoduo had a positive earning. So this means Pinduoduo's ROA meaningful this time. We look at the ROA. ROA here means return on assets. Return on assets. And here we have the most recent information, 2022, July the 25th. We find that in terms of ROA, eBay is still the best. This means for every $1 of company assets in eBay, it can generate $0.083 net profits. It's the highest one. And then followed by Weipi, and then followed by Pinduoduo. Wow, for Pinduoduo, its performance is great. Wow, it's great for Pinduoduo. And then we have, this is Meli. Its full name is called Mercado Libre. Then Alibaba, then Amazon. Okay, for Jingdong, we find that Jingdong's ROA is pretty low. The reason is why? Because Jingdong is a heavy asset company. Heavy asset company. While for Weipi, why it is better in terms of ROA? Because Weipi is a light asset company. Why Jingdong is a heavy asset company? Because Jingdong built up a lot of its own warehouse. We know that warehouse, in terms of the cost principle accounting, it belongs to long-term assets. Long-term assets. And long-term assets, they could be used for many years. At the beginning, in order to build long-term assets, you have to invest lots of money. And the money is being collected back at a slower speed, right? And then Shopify is the lowest. It's the lowest. So this is the most recent information about the ROA of these e-commerce companies in China and US. Next, let's look at the solvency information. So probably you have a question, what is called solvency? Solvency here in a principal accounting, it could be explained as the capability to pay back your debts. The capability to repay debts. Okay, this is called solvency. And short-term solvency means the capability to repay short-term debts. Of course, we have long-term solvency as well. Long-term solvency means the capability to repay long-term debts. Now, let's look at short-term solvency only. If you expect to know more things about the long-term solvency, you can refer to my full version of slides. I've sent the full version of slides to our course media group. Okay? And topic question, how to analyze the short-term solvency. Okay. For short-term solvency, in terms of accounting, short-term here, we usually means 1 year or within the current fiscal year. This is called short-term, right? Probably it's a little bit different from the meaning in common language. This is from the perspective of accounting. Now let's compare the short-term solvency capabilities of different companies. Well, the short-term solvency, although it only talk about the capability to repay for short-term debts, but it's probably one of the major reasons for a company to go bankruptcy, right? Because many companies go bankruptcy is not because of its assets and relationships and their relationships with liabilities. It's not because of assets is lower than liability, but because of short-term solvency, poor short-term solvency. If a company cannot repay for its short-term debts in Western world, a company may be likely to go bankruptcy directly or into a special program called bankrupt protection. So short-term solvency to a company is critically important. And one of the major jobs of a company's CFO is to maintain company's short-term solvency. Otherwise, company may go bankrupt directly. Okay, so it's pretty important when we study company's short-term risk. We have to know something about its short-term solvency. So for short-term solvency, the most commonly used ratio is called the current ratio. The current ratio. I'll explain the current ratio later. But in general, the higher the current ratio, the stronger the short-term solvency. But for current ratio, it's not that good if it is too high. If currency is too high for a company, that means a waste of a company's current assets. We'll talk about later. And then let's look at company's current ratio. Still, we compare these e-commerce companies in China and USA. Usually, for companies' current ratio, by experience, we think it is good around 2. Okay, 1 is still acceptable, but below than 1 is usually not acceptable. Right? And bigger than 2 is not that necessary. Okay, let's look at Sharp. Okay, it's too high. 17 is too high, right? That means Sharp is wasting its current assets. For Pinduoduo, it's 1.7, Alibaba 1.7, Jingdong 1.4, Weipinghui 1.3, eBay 1.3, Meli 1.2, Amazon 1.0. Our standard here is around 2 is good. Bigger than 1 is acceptable. Lower than 1 is not acceptable. Usually it means the company is most likely to fall into a short-term debt crisis. That means it will cause a financial distress in this company. Financial distress. Now let me explain what is called current ratio. We know that in terms of a company's assets, we could have 2 big types. One is called current assets. Another is called long-term assets. Or we have some intangible assets as well. Intangible assets as well. Okay. Current assets is also called short-term assets. Here, short-term and long-term in terms of accounting means 1 year, right? Means 1 year. But current assets means those assets, we can use them or they are available for us to use them within 1 year. So typical current assets is cash and cash equivalents, such as your savings in the bank. Definitely, it is your cash equivalent, right? And also we have inventory. You have made something that put in your warehouse. That will be your inventory ready to sell. So these are all your current assets. Of course, we have some raw materials and something in made. They are also inventory for us. They all belongs to current assets. So the way we discuss current assets is because for current assets, we can convert them into cash theoretically within this fiscal year. So this is critically important for a company or for a business. Means we will have something to use in market within this fiscal year. In this way, current assets is critically important for us. And then in terms of liability, we have similar things as well. We have current liabilities. And we have long-term debts as well. Long-term debts or long-term liabilities. Current liabilities means, of course, they are debts. They are our obligations. Obligations. That means these debts, we have to repay them within 1 year or within this fiscal year. We have to repay them, right? So in this way, when we compare current assets with current liabilities, would be very meaningful in order to analyze companies' short-term solvency, right? So in this way, we use current assets divided by current liabilities. This is called current ratio. In this way, it should be bigger than 1, right? If it is less than 1, that means its current assets, a company's current assets, is not affordable to repay for its current liabilities. This is dangerous, and this is easy to cause a financial distress. However, if it is bigger than 2, it's not meaningful because we have too much current assets. Now, these are the case scripts for the topic case just now. We still use these companies to compare with their current ratio. Okay, let's have a break, 10 minutes.